Ever wondered how the cracks in the commercial real estate market are shaping the future for investors and developers? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Recent reports from Fox Business, highlighted by host Liz Claman on the Claman Countdown, reveal that the commercial real estate market is showing signs of strain. The data indicates that various sectors, including office and retail spaces, are experiencing increased vacancies and downward pressure on rental rates. This trend is not isolated to the United States. In Kitchener, Waterloo, and Cambridge, Ontario, similar patterns have been observed, with vacancy rates in office spaces slowly rising, impacting investor confidence. In the multifamily sector, however, there remains a relative stability, as demand for residential units continues to uphold occupancy rates. This is a silver lining amidst the broader market challenges, suggesting that residential investments might be a safer harbor for those navigating the current economic landscape. Looking across the border, the American market mirrors this duality. While commercial spaces are struggling, the multifamily sector is buoyed by consistent demand, particularly in urban centers where housing shortages persist. This cross-border perspective underscores the importance of diversification in real estate portfolios, emphasizing multifamily properties as a potentially resilient investment. As we continue to monitor these developments, it's crucial for investors and stakeholders to stay informed and adaptable. The evolving dynamics of the commercial real estate market require a keen eye and strategic planning to navigate successfully. We'll keep you updated on these trends in future episodes, ensuring you're equipped with the insights needed to make informed decisions. In the realm of commercial real estate, there's been a notable trend of dead malls being repurposed into residential spaces across the United States. However, the San Francisco Center, which is 93% vacant, is unlikely to follow this path. Despite the potential for transformation, experts highlight several impediments to converting the 1.5 million square foot mall into housing. The challenges include high construction costs, rising interest rates, and the ongoing foreclosure process, which adds a layer of uncertainty to any redevelopment efforts. A crucial factor in this situation is the mall's lack of natural light, which is a legal requirement for all new housing units in San Francisco. The enclosed design of the 9-level shopping center means that introducing sufficient sunlight would require significant structural alterations, such as carving large light wells, making the project prohibitively expensive. The mall's existing floor plates are too expansive, and the interior is filled with storefronts that lack windows, further complicating any conversion plans. Adding to the complexity is the ground lease agreement with the San Francisco Unified School District. This lease requires the mall's owner to pay the district millions of dollars annually, which impacts the financial viability of any redevelopment project. The ongoing negotiations over claims of a ground lease default add another layer of difficulty. Experts like Chris Foley, a seasoned land broker, express skepticism about the feasibility of financing new construction under these conditions, unless there's a significant uptick in the real estate market. Despite these hurdles, there is a potential, albeit challenging, vision for the San Francisco Center. If an educational institution, such as a university, were to invest in the downtown area, the mall's vast empty space could be repurposed into a new campus. This would be more cost-effective than constructing new facilities from scratch. However, this scenario remains speculative and hinges on attracting such an institution to the city center. In Kansas City, neighborhood retail has shown remarkable resilience despite the national narrative of declining malls and store closures. According to a report from Newmark Zimmer, retail leasing activity in the city exceeded new supply by 6-1, driving occupancy rates to an impressive 95.9%, one of the strongest figures in the Midwest. This stability is largely attributed to neighborhood-serving retail, which is anchored by essential services like grocery stores, pharmacies, and local service providers. Parker Webb, a seasoned real estate investor in Kansas City, emphasizes that these tenants remain crucial through every market cycle, providing stability to the retail sector. The strength of Kansas City's retail sector is closely linked to its housing dynamics. While Kansas City ranks among the 10 most affordable major United States markets by rent-to-income ratio, The affordability is tightening due to limited housing supply. With only 2 months of for-sale inventory, demand for rental units is climbing, particularly in Class B and C apartments. Marcus and Millichap reported steady rent growth in 2024, with workforce housing showing greater stability than luxury developments during the pandemic. For investors, these assets are a natural complement to neighborhood retail, building a portfolio that can withstand market volatility. Kansas City's growth has sparked discussions about the impact of investment on affordability and neighborhood stability. Advocacy groups have raised concerns about displacement and rising rents, while city officials advocate for collaborative growth strategies. Examples of successful alignment include repositioned strip centers, housing health clinics, and local retailers, as well as partnerships between municipalities and investors on revitalization projects. These efforts aim to balance growth with community needs, ensuring sustainable development. The fundamentals of investing in Kansas City remain compelling. Retail properties have posted average cap rates of 6.65%, with small strip centers averaging 6.45%. Multifamily Class C assets are trading at around 6.25% cap rates, while Class B properties hover near 5.88%. These figures offer a meaningful yield spread compared to coastal markets, where cap rates are generally lower. Combined with the region's demographic growth and limited new supply, Kansas City presents a differentiated risk-return profile, particularly for those who understand the nuances of neighborhood retail and workforce housing. Kansas City's trajectory suggests a model for how Midwestern markets can balance growth with affordability. If capital is deployed with an eye toward community needs as well as investor returns, the city could become a case study in sustainable growth. As Parker Webb puts it, real estate is not just about buildings, it is about people. Aligning investment strategies with community-strengthening initiatives not only does good but also protects against downside risks and positions for durable returns. According to a report by Cody Baird, the South Mopac corridor in Austin, Texas, is emerging as a significant bright spot in the office market landscape. The area has shown a remarkable resilience compared to other parts of the city and the broader market trends. With its strategic location and robust infrastructure, South Mopac has attracted a variety of tenants, contributing to its growing reputation as a desirable office destination. The report highlights that while other regions are experiencing challenges with vacancy rates and declining rental prices, South Mopac stands out with stable occupancy levels and competitive leasing rates. This stability is attributed to the corridor's appeal to tech companies and startups, which are drawn to the area's vibrant ecosystem and proximity to key business hubs. The report suggests that the success of South Mopac is also linked to the area's mixed-use developments and amenities, which enhance the work-life balance for employees. These features make the corridor an attractive option for businesses looking to relocate or expand their operations in Austin. The presence of green spaces, dining options, and convenient transportation links further adds to the corridor's allure. In contrast to the challenges faced by office markets in other regions, South Mopac's performance offers a glimpse into how strategic planning and location advantages can drive market resilience. As companies continue to evaluate their office space needs, in a post-pandemic world, the success of areas like South Mopac could serve as a model for other markets. In Seattle, the city's largest apartment project, known as Seattle House, has officially hit the market. According to Mark Stiles, senior reporter at the Puget Sound Business Journal, this impressive two-tower 45-story development is set to be completed next spring, following years of delays. The decision to list Seattle House for sale was announced in a LinkedIn post earlier this week, signaling a significant opportunity for investors in the multifamily sector. Seattle House stands as a testament to the city's evolving skyline and the growing demand for high-density living spaces in urban environments. The project's scale and design reflect the increasing interest in multifamily developments that can accommodate a rising population while offering modern amenities and conveniences. This listing comes at a time when the Seattle housing market is experiencing both challenges and opportunities, with affordability and availability at the forefront of discussions. The completion of Seattle House next April is highly anticipated, as it promises to deliver substantial residential capacity to the city. This project not only represents a significant investment opportunity, but also contributes to addressing Seattle's housing needs. As the city continues to grapple with housing shortages, large-scale projects like Seattle House are crucial in meeting the demand for quality urban living. The multifamily sector's resilience in both Canadian and American markets highlights the importance of strategic investments in urban centers. Projects like Seattle House exemplify how developers are responding to demographic shifts and the need for sustainable housing solutions. As we track these developments, it's clear that the multifamily market remains a key area of focus for real estate investors looking to capitalize on growth and stability. As we conclude this episode, it's evident that the commercial real estate landscape is dynamic, with both challenges and opportunities shaping the market. From the transformation of dead malls to the resilience of neighborhood retail and the emergence of new office corridors, the sector continues to evolve in response to shifting demands and economic conditions. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.